Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, we've definitely got a lot of ground to cover today.
We really do. So, based on a stack of recent analysis, things like SEC filings and Q1 2026 earnings reports, the mission for our deep dive today is to unpack this massive move by one of the biggest companies in the world, Berkshire Hathaway.
Right, the absolute titan of investing.
Exactly. And we're looking at their very first major multi-billion-dollar acquisition under their new CEO, Greg Abel.
Which is huge, because analysts have been waiting years to see what the post-Buffett era actually looks like.
Yeah, everyone's been wondering what they're going to do with all that cash.
Okay.
And, well, now we know. According to the data, they are buying a massive American home building company called Taylor Morrison.
But the timing is the wild part here.
That's the hook for you listening right now. They're doing this right in the middle of a massive slump in the housing market. So our central question is, why on earth is this famous value investing powerhouse throwing billions at a struggling American housing market?
Right, it seems super counterintuitive, but to understand it, we really need to look at the hard numbers from the deal.
Okay, lay 'em out for us.
So Berkshire agreed to buy Taylor Morrison. They trade under the ticker TMHC, by the way, for $72.50 a share, entirely in cash.
Wow, all cash.
Yeah. And based on where the stock was in late May of 2026, that's like a 24% premium over its open market price.
Okay, so they paid up for it. Now, looking at the recent analysis, the finance jargon gets a bit dense here. It mentions a $6.8 billion equity value, but then it also says the enterprise value is $8.5 billion.
Yeah, those numbers confuse a lot of people, but the difference is actually really important for a deal this big.
I think the best way to think about it for you listening is, well, imagine buying a house in your own neighborhood.
Sure, that's a good way to look at it.
Right, so say you agree to buy this house, and the cash you hand over for the keys is $680,000. That is your equity value. That's the $6.8 billion Berkshire is paying for the actual shares.
Yeah, exactly.
But let's say the previous owner had a $170,000 loan to, I don't know, redo the kitchen and replace the roof. If you want the house, you have to take over that debt.
You're on the hook for it.
Right, so your true cost to own that property free and clear is actually $850,000. That total cost, with the debt included, is the enterprise value.
That's a perfect analogy.
Yeah.
You always have to look at the debt on the balance sheet to see the true price tag. Berkshire's really taking on an $8.5 billion commitment here.
Got it.
And another key detail from the filings is that they're taking Taylor Morrison private. So no more stock market fluctuations to worry about. But they are keeping the current CEO, Sheryl Palmer, in charge.
Okay, so if Berkshire is keeping the current management, they must really love what this specific company is doing, right? I mean, there are dozens of home builders. You drive down any highway and see signs for them.
Oh, yeah, they're everywhere.
So what makes Taylor Morrison so special that Berkshire drops billions on them?
It really comes down to their scale and their whole operational ecosystem. According to the research, this isn't just some guy with a hammer and a pickup truck.
Yeah.
They operate across 12 states, 21 different regional markets, and they have over 350 active communities.
That is a massive footprint.
It is. And they build for everyone. Entry-level homes for first-time buyers, luxury resort living, and they even have this distinct brand called Yardly that just builds rental communities.
Wait, really? Like entire neighborhoods built specifically just to rent out?
Yeah, exactly. Build to rent.
That's wild. That feels like a big shift from the classic American dream of owning your home. It sounds like they're just adapting to all the people who simply can't afford to buy right now.
That is exactly what it is. A direct response to the economy. People want a backyard. They don't want noisy upstairs neighbors, but they can't get a mortgage. So Yardly steps in.
Makes sense.
But here's the real hidden value. Taylor Morrison doesn't just build the physical houses. They also provide the mortgages, the title services, escrow, and the home insurance.
Oh, wow. So they're basically a giant financial services company hiding inside a construction firm.
Exactly. And when you combine that with Berkshire Hathaway's existing companies, it's brilliant. Berkshire already owned Clayton Homes. They own Shaw, the flooring company. They own Johns Manville Insulation, Benjamin Moore.
But I see where this is going. It's like Apple's ecosystem, right?
But for suburban housing.
Yeah, that's exactly it.
Like when you buy a phone, Apple isn't just selling you the hardware. They want to sell you the apps, the cloud storage, the charger. Berkshire's doing that with neighborhoods.
They want a piece of everything. Right. They supply the Benjamin Moore paint, the Shaw flooring, the Taylor Morrison mortgage to actually buy the place, and then their own insurance to protect it. You're basically living inside a closed-loop corporate product.
It's incredible synergy. Berkshire captures the profit at every single step. Raw materials, construction, and long-term financial servicing.
Okay, so that ecosystem sounds amazing in a vacuum. It sounds like a money-printing machine.
It does.
But we don't live in a vacuum. I have to push back here because if you look at the broader economy, why buy this company right now? The housing market is terrible.
It's definitely a rough spot.
Yeah, I mean, if you look at the mid-May 2026 data, mortgage rates hit a 9-month high of 6.51%. I was actually looking at houses a while ago, and seeing those rates on a basic 3-bedroom home is just, it's paralyzing.
Oh, absolutely.
You do the math and realize you're paying thousands more a year just in interest. It feels like the worst possible time to buy a home building company.
And you're not the only one feeling that paralysis. The data backs you up completely. The April 2026 housing numbers are just grim. New single-family home sales fell 6.2% from the previous month.
Ouch.
Yeah, and they're down 11.3% from the year before. Because of that, inventory is just bloating. There's currently a 9.4-month supply of new homes sitting on the market.
Okay, for the listener, let's break down why that 9.4-month supply number is so bad.
Yeah, it's a critical metric.
Because for a builder, an empty finished house isn't just sitting there neutrally. It's an active liability, right? They're paying property taxes, security, maintenance, and crazy high interest on their own construction loans. Every month it doesn't sell.
Right, they're bleeding cash.
And once it hits like a 6-month supply, they usually have to slash prices just to stop the bleeding.
Which is exactly why the data shows single-family housing starts like new projects breaking ground drop by 9%. Builders are literally stopping work because they can't afford to hold more empty houses.
They're just squeezed on all sides.
Totally. Land costs are crazy, there's no skilled labor, and materials are super expensive. Plus, under President Trump's current policies, we've got renewed tariffs on imported materials.
Just to clarify on that, based purely on the data and making sure we stay completely impartial here, those tariffs just mean builders have to pay fundamentally higher prices for things like Canadian lumber or foreign steel.
Exactly. Regardless of politics, it's just a raw increase in the cost of doing business. It eats directly into their margins.
So to recap, local builders have high land costs, expensive labor, tariff-inflated materials, and buyers who are totally priced out by high interest rates.
It's a brutal environment.
It's toxic. Which brings me back to my question. If it's this bad, why is Berkshire Hathaway diving in right now?
Well, this is the contrarian genius of Berkshire. Most retail investors see dropping sales and high rates, and they run for the hills.
Right, they panic.
But Berkshire is looking at a total different reality. They see the short-term pain of high rates, sure, but they know it's just masking a long-term problem. America has a massive fundamental housing shortage.
Because we basically stopped building for a decade after the 2008 crash.
Exactly. And meanwhile, the population kept growing. We have this ongoing household formation. Millions of millennials and older Gen Z folks are aging into their prime home buying years.
They're getting married, having kids.
Right, and they physically need space.
That makes sense. I mean, when you watch the news, all you see are expensive mortgages and unsold homes. But Berkshire is looking past this current slump. People might delay buying a house for a year or two because rates are gross, but eventually, life happens.
You can't raise a family of 4 in a tiny apartment forever.
Exactly. People will always need a place to live. So Berkshire is basically betting on human biology and social reality.
Yeah, they're buying a long-term asset during a temporary panic. And we can't ignore the biggest advantage they have here, their balance sheet.
Oh, the cash pile.
Yes. We talked about that $6.8 billion price tag. For almost any other company, that is a huge bet-the-company risk.
Yeah, they'd have to borrow heavily.
But recent research shows that as of Q1 2026, Berkshire had a record cash pile of $397 billion.
Oh, $397 billion in cash.
Yep. So $6.8 billion is literally less than 2% of their cash on hand.
That completely changes the rules of the game. It's not a gamble for them at all. It's just a strategic placement of spare change.
Basically, yeah. And this highlights a huge shift in the industry. Home building used to be really fragmented, small builders everywhere, all getting crushed equally when the Federal Reserve raised rates.
But no.
Now, according to the data, it is all about economies of scale.
Okay, think about it like this for you listening. Imagine these high interest rates are a massive financial blizzard.
Oh, I like this.
Right. So the small local builders, the guys doing maybe 10 custom homes a year, they are out in this blizzard wearing a t-shirt. They are freezing to death.
They have no protection.
Exactly. They can't get cheap loans, they can't buy lumber in bulk to get a discount, and they definitely can't lower their prices without going totally bankrupt.
But then you have Taylor Morrison.
Right. Giant platforms like Taylor Morrison, now backed by Berkshire's $400 billion, they're walking into that same blizzard wearing a heated, heavy-duty Everest snowsuit. They can negotiate bulk discounts from their own sister companies to fight off the tariff costs.
And more importantly, they can literally manipulate the interest rates for their buyers.
Yes. Let's explain this, because to a regular home buyer, it sounds like magic. How does a massive builder offer, say, a 4.99% mortgage when the national average is at 6.5%?
It's a strategy called a mortgage rate buydown.
Okay.
A mega builder will take some of their profit from the sale, maybe 20 or 30 grand, and pay it as a lump sum directly to the lender up front.
Wow.
Yeah, and in exchange, the lender artificially lowers the interest rate for the buyer for the first couple of years.
So the builder is literally using their giant cash reserves to subsidize the buyer's monthly payment just to get the house sold.
Exactly. And a small local builder trying to survive on tiny margins, they just do not have 30 grand in spare cash to pay the bank up front.
So they lose the customer.
Every time. And that's why the mega builders are actually capturing market share right now, even in a slump. But I want to give a quick warning here for the listener.
Oh yeah, what's the rookie mistake people make here?
When retail investors see a headline like Berkshire buys home builder, their instinct is to jump in. They log into their brokerage and buy a home builder ETF thinking Berkshire's calling a market bottom.
And the data showed home builder ETFs didn't even get much of a bump from this news, right?
Right. Because buying an ETF of public stocks is totally different from what Berkshire is doing. An ETF is subject to Wall Street's daily panic. If rates stay high for 2 more years, those public stocks will get crushed.
Berkshire isn't playing the stock market game.
No, they're using massive private capital to buy the whole asset, take it private, and hold it forever. They don't care if its theoretical value drops 10% next year.
Because they're never going to sell it anyway. They're just waiting for the blizzard to end so they can own the whole landscape.
Exactly.
Okay, let's recap this journey really quickly. We've seen how Berkshire's new leadership under Greg Abel is keeping the classic value playbook alive, but applying it to buy this massive vertically integrated housing ecosystem.
Right, controlling everything from the paint to the mortgage.
And we saw how they're using their unbelievable cash pile as a shield against these high interest rates and brutal market conditions, betting on the fact that Americans will always need homes.
Which really leaves us with kind of a heavy question to think about.
Lay it on us.
If the only way to profitably build homes right now in this high-cost environment is through massive corporate scale and vertical integration, what does that actually mean for the future of the American dream?
Oh, wow. Yeah.
Will the neighborhood of tomorrow be entirely bankrolled, built, insured, and managed by just a handful of mega corporations?
That is a wild thought. You're basically talking about neighborhoods becoming a corporate subscription service. We started off talking about a simple corporate buyout and ended up questioning the whole future of how we live. But that's exactly why you have to look past the scary headlines and see the structural moves happening behind the scenes. Don't forget to subscribe and hit that like button.